Hi, I'm Joel Gilgard with Gilgard Analytics. Thank you for tuning in to this YouTube video clip. This tutorial will cover world unemployment during the past generation from 1989 through 2022. And the file that we're going to go through is housed out on Gilgard Analytics website. And so most of these files that we make available consist of two tabs: notes, basically with background information, what they're about, with some graphs, and then you have the underlying data for this index. And so what we're going to be looking at is historical global unemployment rates from 1989 through 2022, so basically through December of last year approximately. And we'll be covering 40 countries around the world. And so this has been transformed into the Gilgard Unemployment Index. This one, since it's only in percentages, there's nothing that's adjusted for inflation. So getting started, we will look at the cycle value graph. And the way to read the cycle value is in terms of unemployment, what is good or bad from a stock market perspective is when unemployment is very low, that means that the economy is stretched very thin. So like the end of last year, you had the Czech Republic, Germany, New Zealand, United Kingdom, and the US. When it's very, very low, it'll put pressure on resources, and it will induce the reserve banks around the world to increase short-term borrowing rates, which has happened, which then makes it more difficult for people to borrow money. That goes for companies and individuals. And so people then, this is the economic theory of what happens. It doesn't always happen lockstep, but so people will then postpone purchases. They might just decide not to make the purchase at all. They'll make do with what they have or buy used. And this then leads to corporations reducing workforces, which then increases the unemployment rate. So from an investment perspective, asset allocating view, speculative view, the higher, basically the lower the score is, if the negative means that you have a very low unemployment rate. That gives the Fed very little room to lower interest rates. Now, on the flip side, where you have higher unemployment rate, the cycle value is positive. So right now, China and South Africa, they have very high unemployment rates. South Africa is quite a different story. They've been high for quite a while. But this will induce China to lower interest rates, come up with other stimulus, and that's the same thing with Pakistan, Austria, Brazil, Chile, Turkey, and Taiwan. Now, looking at the Gilgard Unemployment Index chart, and this is the historical chart going back to 1989. This is an equally weighted average. So you take the unemployment rate in each country, you just divide it by its own intrinsic average, and here is where you come up with these numbers. So when starting in 1989, the world was doing pretty well. Unemployment was at its lowest that it's ever been in this chart, although they come very close end of 2022. So basically what happens is the world raised interest rates up until early 90s. Unemployment fell again. Or I beg your pardon here, they lowered interest rates up until the early 90s because unemployment was going up. Then all the way after the whole internet and Y2K incident, unemployment rose around the world. So interest rates were lowered. Interest rates were also lowered all the way down to the financial crisis there of 2007, 2008. Unemployment rate decreased, meaning that the employment situation becoming pretty tight. And then after 2008, people lost their jobs. Interest rates, followed basically downwards. And so then we had a very, good period here for the past, for these 10 years, where unemployment was steadily going down. And then we had, the Y2 or the COVID pandemic, where unemployment around the world shot up. And then, after that, interest rates were lowered, and unemployment went down again to below or around 6% around the globe. Tightening labor markets, leading governments, their reserve banks to increase interest rates. And so just taking a quick peek here, we're not going to look at all these countries, but we'll look at Argentina. So currently unemployment rate is 6.9, historical is 9.9. Australia, it's at 3.4. The average is 6.5. Austria is pretty much right on average. Belgium is below average. Brazil is below average. Canada is below average. Chile is above. China is above. Colombia is below. Czech Republic's below. So the story repeats itself. There are some countries, like we mentioned earlier. We have, let's just take a peek here at South Africa at 33%. So South Africa is going to have to do something drastic to change their ways, because the unemployment rate is not repairing itself. And then, of course, we'll take a look at the U.S. So U.S., the average unemployment rate for this past generation is 5.7%, and the current rate is 3.7. So you take 5.7, you subtract out the standard deviation. 3.7 is way below that. So, for 2023, you should have expected the Federal Reserve to raise interest rates. I hope you found this tutorial interesting. If you have any questions, any comments, please let us know. Thank you.